So I was recently asked this really interesting question. So if you were to restart, how would you invest $1,000 today? So me being curious, I went onto the likes of YouTube, Google, and even Reddit to search for answers. Surprisingly, or unsurprisingly, everyone on the internet has an opinion. I'm guilty of that too. So when I filter down to the range of responses, there tends to be two types of opinions. And here's what I found. Now, in the first bucket, it is the traditional form of advice that tells you to focus on increasing your income, improving your skill set so that you can save more money, and maybe even invest in yourself via education. Don't spend too much time thinking about what assets you can or cannot buy with $1,000 because it's not going to be enough to help you reach your financial goals. Logically, this makes perfect sense. So even if you have to 10x your money from here, and don't get me wrong, 1,000 to 10,000 is a decent sum, but it's certainly not enough to take you to places. On the other hand, the second bucket of opinions revolves around finding the optimal asset to invest in, whether it's through bonds, through stocks, or even cryptocurrencies, and even alternative means like paintings or NFTs or whatnot. So before we get ourselves dirty with all the discussions and analysis in the second half of this video, I would just like to make my position clear. So I'm in agreement with the first type of responses. I don't think $1,000 is enough to buy you the ticket to financial freedom, unless you can find the next 1000x crypto or something like that. But that's not the focus of this video. Instead, I just wanted to push the boundaries and really explore what can you do with $1,000 today in the stock market. Why? Because I think there are quite a few commonly held beliefs amongst those that have resisted investing for the longest time ever. Beliefs such as you need a lot of money to begin investing, investing is just a sport for the rich, or I'll start investing when I'm older or when I have much more money. So the point is simple. I think we just want to dispel some of these myths, share our thinking framework, and more importantly, get people interested in investing as early as possible. Besides, the earlier you start, the more time your money can grow through compound interest, and you can recover much more quickly in the early stages. So like any sport, you need to train up that financial muscle over time. So in this video, I'll be sharing with you 5 stocks that I would invest in with only $1,000 to start with. And to make this challenge even more interesting, we need to set some boundaries because as they put it, restrictions actually breeds creativity. So here are 5 rules that I came up with. Number 1, they will all have to be US listed companies. Number 2, I must buy at least one share of each company, even though fractional share trading is available via most exchanges. Number 3, I must personally want to own shares of these companies and not make a video just because. Number 4, the company's valuations must be tolerable, preferably undervalued by my own estimation, or at most at fair value territory today. I'll try to avoid those that I think are crazily overvalued. And 5, lastly, I'll try to choose from different industries so that we can achieve some form of diversification. So given these constraints, before we dive into our own pick, you can pause the video and list down your own opinions on how you would split this $1,000 investment. And like every video, please take this sharing with a huge bag of salt. Focus on how we analyze and look at things rather than come in just for the so-called stock tip and buy without thinking. So with the disclaimers out of the way, here's how I would allocate the $1,000. And of course, 100% of the $1,000 would be allocated to smashing the like button and subscribe. If you can smash it for 1,000 times, you'll prosper for 1,000 years. Now, back to the $1,000 allocation. So in Piranha Profits, we actually segregate stocks into 8 different large categories. Large cap predictable, large cap growth, deep value, deep cyclical, dividend cash cow, ETFs, turnarounds, and speculative growth. So when constructing a portfolio, you'll want a different makeup of these different categories, depending on your financial objective. So for this allocation specifically, we'll focus on the large cap growth side of things to provide a strong base for the foundational layer of the portfolio, while also allocating a small portion towards potential turnarounds and even speculative growth stocks in our attempt to outperform the index. So I think when we talk about investing, especially in today's climate, all eyes would be on the Magnificent Seven stocks. So they're namely your world-renowned Apple, Microsoft, Amazon, Alphabet, Meta Platforms, Nvidia, and Tesla. So you don't need to be an investor to know that these 7 companies exist. They're literally embedded in our everyday lives. And for passive investors that invest their monies through a broad-based index like the S&P 500, $30 of every 100 you put into it goes into these 7 companies. So given the restriction of this challenge, I would only add Amazon and Alphabet into our portfolio mix. So at the time of this recording, Amazon is trading at roughly $170 per share, and Alphabet, the parent company of Google, is at $164. So that's $334 out of $1,000 budget, roughly 33%. And this mirrors quite closely to the S&P weightage of the Mag 7. And I'm comfortable with working with that. So let's walk through why I chose Amazon and Alphabet over the rest. Firstly, I do think that both companies are one of the most competitively priced out of the 7. Their core businesses are also different enough that gives you a broader exposure. So Amazon's core stems from e-commerce and cloud, while Google brings advertising to the table. They do kind of overlap, as Alphabet has a cloud component while Amazon also has an advertising component, but I think it's varied enough. And if you were to ask me, hey, for the Mag 7 in general, without this challenge restriction, which do I actually prefer? I actually prefer Meta Platforms over Alphabet for advertising exposure and also their execution track record. But because of the restrictions of minimally buying at least one share of each company, I don't mind going with Alphabet instead. For Apple and Microsoft, they're good in their own right, but I would prefer a more palatable valuation. Nvidia and Tesla are tricky subjects to navigate. I think existing investors tend to have very polarizing opinions of whether they're either bullish or bearish of each stock. So for now, I don't think I have a good enough grasp of the company's outlook ahead, so I'll continue studying. I don't think we should shut our doors and say that we will never invest in either of them. I think there will come a right time and right place, but maybe not for this challenge. Now that we've got advertising, cloud, and e-commerce covered, the next largest industry I would want exposure in would be the financial sector. And when you think about financials, companies like insurance, banks would come to mind. Instead, I would choose to add Visa to the portfolio. So Visa is a digital payments company which basically takes a blanket tax on the world's digital payment ecosystem by providing the infrastructure to support fast and secure transactions. So they do run a duopoly with MasterCard, and if you want a company that is growing faster, I don't mind switching out Visa with Master. But again, taking into account the consideration that I have to at least buy one share, I think Visa is a good enough alternative. That said, I do think that they're trading near to fair value today. So Visa is right around $269, which brings our total invested amount to $603. So now that we have got our bases covered with strong, fundamentally sound, and some of the best enterprises in the world, the last 2 stocks I'm looking at is something that we believe that is temporarily beaten down, that fits our budget, and has an enticing recovery runway ahead. So want to take a guess what they are? Well, they're Lululemon and Disney. You're probably wondering, oh man, you're picking such great companies. Why are you catching falling knives now? I understand that some of you might have concerns about Disney and Lulu not being conventionally safe or sure win, especially if you look at their recent price action. However, I think we are constructing this allocation based on our research and conviction. And we do think that these names have a shot at beating the index if our theses do play out in the medium to long term. So we'll also focus on sizing it based on their risk profile. So let's first talk about Lululemon. So we have first talked about this stock in our previous video, top 3 quality stocks excluding the Mag 7, and outlined the current worries and theses for its investment case. So for Lululemon, we do acknowledge that they have a narrow moat, but over the past 4 years, they've proven their worth by executing and scaling. Lulu is considered large cap growth at around a $30 billion market cap, which is moderately cyclical. If you do believe that they are able to continue expansion while accruing towards their strong brand equity, then I think you have pretty exciting runway ahead. Next, for Disney, they're probably parked under turnarounds. So Disney was impacted on multiple fronts, from lockdowns to their struggling efforts to digitize, to penetrate into the streaming industry with Disney Plus to a messy leadership transition. And their financial results have since taken a hit, and so did their share price. So like any turnaround plays, you are betting for recovery, and it's up to the individual investor's assessment on whether you think the company is able to unlock its value. So suppose that we added Lulu at $258 and Disney at $89 with a spare change of $50. So to throw in an additional bonus, I think Celsius is an interesting speculative play. So Celsius is an energy drink company that is providing a healthy alternative to the marketplace. Growth in recent quarters is taking a hit, but it boils down to where you see the overall energy drink market is heading and whether Celsius is able to carve out a pie of its own. And since it's the speculative portion of the portfolio, it will not take up a huge chunk of the allocation. So in total, we have deployed $988 into 6 names that are in the categories of large cap growth, predictable, moderately cyclical, turnarounds, and even speculative. We are in industries like advertising, cloud, e-commerce, athleisure, entertainment, and even energy drinks. So I think we've got an interesting portfolio right here. So feel free to leave in the comment section down below on how you would deploy this $1,000. So full disclosure, I do own 3 of the 6 mentioned companies. So just know that I'm putting money where my mouth is at. So I'd just like to reiterate that this is a fun experiment / challenge. And of course, it's not financial advice. Please do not go out and buy these stocks just because we've discussed them. And a quick reminder that investment returns with a small capital sum is not going to be the main driver of your portfolio growth. Focus on saving up, build that financial muscle, so that when it comes a time when you're managing large sums of money, you will not feel foreign and lost. So this is CK from Piranha Profit signing off. Till next time, keep winning.